Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our FSC show a little early because we have Thanksgiving ahead of us, and then a very, I hope, lazy Friday, but you never know. You know, we've had a lot of fun times on Fridays driven by OPEC, so hopefully they can be quiet during this Thanksgiving Friday. So with that being said, one piece of housekeeping, after 2.5 years, so after 2.5 years, this will be the last free frac spread show. The other shows will remain free, and we'll try to do a bit more smaller content. But you can go to primaryvision.co for a special offer this weekend, which is going to be a Black Friday through Cyber Monday special of 40% off. Small, it's not expensive, I promise you, and you'll keep getting not only what we do here, but also some articles and insights that we write, and we'll start making the slides available. So we hope to see you on the other side of that paywall. With that being said, today we're just going to do the FSC show. We've already done the EIA show. I'll do a little bit on the economy side, but how it ties back to a weakening crude demand. And then next week, I want to do a bigger show on NGLs and natural gas liquids and how prices have softened and what does that mean as we go into year end, also as we go into next year, because there's going to be a lot of things to look at and discuss. So with that being said, the Primary Vision Frac Spread Count came in at 300. So we finally did it. We made it. We've been talking about 300 as the level. I'm going to be honest with you. I didn't think we were going to get there. I thought 297 was going to be our peak, but we did get there. Now, typically this week, or I should say, from Thanksgiving on, you have a fairly sizable slowdown, and we'll probably, if we stop at 300, we'll likely get to about 275, maybe 265, but usually we should get to about that level out, and that's again very seasonably normal. That's as we head into year end. Typically, that's 6 weeks between Thanksgiving and New Year's is that quiet period, and then things really start to get back. The Permian is up to 160 spreads. A nice little nugget of information. That is the high point that we've been at. You know, that's really kind of the maximum of where the Permian can be, with some other areas seeing, especially some of the smaller areas, seeing some additional activity. But when we look at rig counts were up slightly by 2. You can see oil was up by 4. But the important thing in general is that the directional was the one that actually drove most of this. So it's important to weigh that in terms of where is directional, what is happening there. And here you can see that directional is important, but the horizontal's holding firm. And that's where, when you look at the activity, horizontal rigs and rig activity should stay a little bit more elevated than the frac spread, which is going to increase the amount of DUCs that are available as we go into next year, and really support our view that under this pricing regime, we should get to about 12.7 million barrels a day, off of our exit rate of about 12.3, maybe 12.4. But again, we've been right in that in line with that. As we go forward, the biggest issue is really going to center around where is demand. And as we talked about on the EIA show in segment 3, a lot of uncertainty around OPEC. They've talked about, or at least the headline was an increase. And remember, those are tape bombs. They drop them regularly to test the market reaction. They did it a lot in 2014, 2015, 16, 17. So we should be used to it by now. The question is going to be, where do they go from here? And realistically, given the amount of crude in storage, crude in floating storage, OSPs will likely get cut, and that is also going to help demand a little bit, because we're facing a much bigger problem, especially when you start looking at where is demand in general. And I think these are good charts looking at the average days per week working from home after the pandemic ends. And you can see that the employer plans are 2.3 days working from home. The percentage of paid full days work from home continues increase, but it's flatlined. And that's where, when we look at flexible schedules, is the more consistent thing that we're seeing and we think is going to be the normal case. And that's going to, again, eat into some of that gasoline demand. But then when you start looking at the global slowdown, which we'll talk about in a minute, that's going to put a little bit more weight on, well, what is happening on the distillate front? If manufacturing is slowing, what does that mean? How is that going to impact diesel and distillate demand, which is why we remain concerned on the demand side. Now, supply has been coming down in kind of lockstep at this point. And now demand destruction is overtaking that just a bit, which is why we've seen the physical market get so weak and has pulled down now the futures market. We do think there is some support in the futures market here, but again, these are some interesting things that we're seeing. Then when we look at Russian gas supply to Europe, you can see of where we are right now. There's rumors that starting this week, Russia will shut down even more natural gas going into Europe. And that's the question is going to be, what happens to the polar vortex? What happens to what does Mother Nature throw at us? Do we get the polar vortex? Do we get more extreme winter weather in Europe, which can exacerbate some of the issues that they've already taken to preserve storage? They've shut petrochemicals, they've shut fertilizers, refiners, things to try to preserve this natural gas in storage for consumption during the winter months. Japan, which I think is hysterical, has said that they're promoting turtlenecks because they're saying that turtlenecks keep you warm. So they've pushed out in a marketing campaign to buy more turtlenecks to wear them and push companies to put them on sale. Just so that people can afford them. And again, if that's the near term and long term solution, we're going to have a lot of problems as we head into the seasonal extremes. Now, this is an important one when you start looking at food staples, because this is how staple food price impacts inflation. And when you look at emerging markets, they're very susceptible to food inflation and how that impacts spending. And as food prices remain elevated, well, how are they going to increase their demand? What is their demand bounce going to look like? Which is why we remain concerned at the emerging market side, especially as we talk about the OECD nations, that flow down, where as things slow at the top side in OECD, G10, G20, that has a reverberating impact as you see less and less activity because the ordering slow down in general. And before we show that, I just wanted to point out the emissions trajectories, and it's important to highlight of the trajectories that we currently sit in versus China, versus India. We get a lot of flack within the U.S. in areas of what we're doing, but is it really us that's the problem? And that is a comment that is not meant to say that we shouldn't continue to do something to address it, because I'm not saying that. We should. We have the technology, we have the ways to deploy it. So if you can make the world a better place, and especially if you can make money doing it too, by all means, even if there isn't the greatest return, there's still a certain amount of incentive to drive that. But we still are a connected world. We still share the same atmosphere. So we really have to look at other places, and are we getting cleaner because we're sending the dirtier stuff abroad into China, Africa? And I think that's going to be an interesting topic as we go down the rabbit hole of scope 1 through scope 4, because as you get into scope 3 and scope 4, you now have to account for where some of these raw materials are coming from. And I think that hopefully opens up some eyes to what is happening throughout the supply chain for things that are viewed as quote unquote green. And realistically, when you do the full life cycle, they're not as good as initially perceived. But when you look at things going forward, this is the OECD leading indicator, and I think a bigger component of the problems that we're seeing on the distillate front. You can see that the leading indicators are below where they were in 2009. Obviously, COVID was the shock, but you can see that it's a more steady move down. And the conference board in the U.S. for leading indexes is showing something where that number hasn't existed unless we were in or about to be in a recession. And again, leading us towards that path with a number of consecutive months of monthly leading indicator declines. And you can see the gray areas are every time we've had a recession. So you can see we're approaching a point where there was only one time that we got to this level and didn't have a recession. And again, I can't stress enough the problems that we're facing. So 8 consecutive monthly contractions for leading economic index, entirely consistent with prior recessionary behavior. Though 2006 8-month streak was early, it preceded the great financial crisis. And then the CEO confidence, it is at the extremes that it hasn't been at since 2006. So again, that's going to pull down EPS, that's going to pull down CAPEX. And all of this leads to that weight on manufacturing output. So when you look at industrial production and you look at where Empire State is in orders versus inventories, you look at Philly, you look at Richmond, you look at all of these things, the average regional Fed CAPEX intentions are drifting lower, leading to more initial slowdowns, and is going to impact demand even further as we go forward on that middle distillate, on that heavy distillate side, where we're not going to see, I think, some of the demand estimates that are out there. Now you take some of the new data from the U.S., and I want to point to the S&P Global U.S. Manufacturing PMI. It was expected to be at 50. It came at 47.6. Services was expected to be at 48, came in at 46.3. 46.1, putting the composite at 46.3. So again, firmly in contraction. Is this a one-off? And if you've been watching us, listening to us when we talked about regional Fed, all of these things, to me, the answer is no. This is what it is. It is happening in such a way. We'll take some of the other pieces and go into it. New homes has had a good number. Some of that could have been seasonal. Get all of this locked in prior to November and December, but we'll dig into that a bit more. And then if you look at University of Michigan sentiment, things have balanced out a bit, still at the low end, but moving higher. I thought this was a fun chart. This shows you the cost of the Thanksgiving feast. And you can see that the cost going back to 1990, this is the most expensive Thanksgiving has been since that time period, which I just thought was a fun chart to look at. And then that leads us to junk bond and loan sales slide to the lowest level since the financial crisis, which is a problem that we continue to see. And again, the struggle of trying to issue debt, which is also because when you look at the emerging markets face $2 trillion of bond and loan redemptions until year end. So there's a lot of wood to chop when you look at stuff that's going to get rolled, stuff that needs to be either issue new debt or try to find a way to afford not having to being able to repay it or roll it. What is your rate going to look like? What is that going to do as you have more supply coming to market? That's going to hurt demand, which hurting demand is going to push up rates. Because remember, price and rates and yield are inverse. So as rates come under pressure, that's going to push things higher and create more stress. So we think that the bond market, especially in the emerging market world, is going to struggle. COVID restrictions have kept rising in recent weeks in China, even though technically they were supposed to fall. And again, we don't see that changing. It's all about control. There's been a fairly sizable increase in activity, and just the type of COVID that is now in China is very contagious. And tends to be not as severe, so you don't get the same symptoms, so it's easier to disseminate, which is why we think that the belief that the zero COVID policy is going to go anywhere anytime soon is still a bit overstated. Chinese consumer confidence index still ridiculously low, coming back to the lows, and then the annual change in household. They're not taking loans. And we've talked about this multiple times. There's no demand for loans, and that is creating this problem because the PBOC is pushing it. The CCP is pushing it, but there's no takers. The companies don't want them. People don't want them. And they would rather turn around and put money into savings. But you might say, oh, well, those deposits can then come out. Well, if you have massive losses in your portfolio from housing, from real estate, from down payments that you'll never get back, or the asset that you put a down payment on is now, essentially insolvent, is that really going to anything outside of trying to cover your coming debt versus something that is pent up to be spent? It's probably a mixture of both, but it's not all one or the other. And again, I think the spending side is going to be muted. And this just looks at when you look at construction market share, the state-owned entities have taken over in terms of the construction side just because non-SOEs can't afford it. And then the housing market share, you're continuing to see state-owned enterprises trying to drum up, which is not a long-term solution. Remember what we said at the very beginning: when things get tough, countries either go more communist or less communist. And we know based on the USSR what happens when things start to get worse and you increase control, increase control, increase the communist push, that leads to the collapse. And that's a problem that we're seeing right now in China, which is something to consider as we continue to go down this route. That is what we have for you today. We hope you have a great Thanksgiving and spending time with friends and family. We hope you have safe travels, and we will see you next week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.